Hi everyone, Beth here. In the last video, the introduction to the chapter, we started talking a little bit about the planning assumptions, and I referred to page 272 at the bottom where it starts talking about a few of the assumptions, both external and internal, that we need to consider before we can start creating our budget for the next year. A couple of them being, our internal labor costs and the cost of our raw materials, as well as external factors, things that are going on in the economy, such as the tax rate that we will have to pay, and if we deal any into international markets, what is the exchange rate for our Canadian dollar, and should we bill those external customers, should we bill them in their own currency or should we bill them in our currency? Okay, so now we're going to start talking about the budgeting process. And once we figure out all of our goals, if we need to alter our mission statement, is our overall strategy for our organization, we're going to start looking at budgeting for these assumptions. Okay, and we start looking at budgeting on page 277. So again, we have been creating financial statements since back in January when we started with our car wash example, and you all did exactly that. We were looking at this being a brand new company and figuring out what our company was capable of, what its goals were, how many wash bays we wanted to have, how many employees we were going to have. So you've worked through the budgeting process. You've figured out the financial projections for that organization. You figured out what the owner was going to have to input out of their own money in order to make everything balance. You figured out whether or not you needed to have a loan in order to cover the purchase of the equipment. So you've done all this. So now we're just going to put these into place and do a couple of examples on them since we're not going to be doing our individual projects. Okay, so when we look at it, if you can see here, the bottom row, that's where we start. So the sales budget. And just like we talked about, what do we think the market can support for the selling price to the customer? How much do we think our customer is willing to pay? The manufacturing budget, figuring out what the cost of our raw materials are going to be, what the cost of our labor in production is going to be, and the overhead budget, looking at how much it's going to cost us for fixed costs mostly, such as rent, such as how much are we going to have to pay for certain equipment, and then depreciate it. And if we depreciate it using a straight line, then those are also fixed costs. And then all of this is going to roll up into our cash budget. And if you remember what the spreadsheet looked like that I showed you we were going to use for your project, that was a cash budget. Cash coming in and cash going out. And in the end, what is the amount left in our bank account? Okay. So feel free to have a read through the chapter pages on budgeting. It starts on page 277 and it goes over pretty much just to 278 where they're talking about the operating and the sales budget and the flexible budget being the cost of goods sold. Um, what are those variable costs? So from last chapter, variable costs that change related to every time we sell a good. So for example, if we're making coffee and selling coffee, what are the variable costs? So the cost of the actual coffee, the cost of the sugar that our customers are putting in it, the cost of the milk that the customers are putting in it. If it's a takeaway cup, then the cost of the cup and the cost of the lid. And then the overhead would be how much is it costing us to rent the facility? How much is it costing us to have an employee on site to sell? That's more of a semi-fixed, semi-variable cost because it's not going to change for every cup of coffee that we have. It's going to be based on um, the hours of operation and how many people we think we're going to need on site at any given time. So if it's lunchtime, maybe we need 2 people there. All right. And then on page 279, they're talking about strategic budgets and zero-based budgeting. Zero-based budgeting is a very interesting concept. I implemented this in several organizations that I worked with, and one of I think we talked about it actually, um, one of the expenses that it really comes into play or should come into play is marketing expenses. So maybe your organization spent $10,000 last year on marketing expenses. Doesn't mean that your organization should spend $10,000 next year on marketing expenses. Have your marketing manager figure out, okay, exactly what are they going to spend that money on? So say your budget right now is 0. Prove to me that you need more than that. What are you going to spend it on? Are you going to trade shows? Are you planning on giving certain customers um, special discounts or free samples? Build your budget, tell me what you're going to spend it on, and then we will look at improving it or approving the expenses. That's on page 279. Balance scorecard we're not going to cover. Okay, so now we're going to get into a little bit of the actual um, the cash budget on page 284 and 285. I will create the next video. I'm trying to keep these videos around 8 minutes.